In this episode, we are going to talk about internal and external liquidity. I will explain when to use internal liquidity and when to use external liquidity. This concept is powerful when you have a clear bias towards one direction. So let's get into it. The first thing we are going to do is clearly define internal range liquidity and external range liquidity, because if you do not understand the difference between these two, you will constantly be confused about where price is likely to move next. Internal range liquidity is simply a fair value gap. It represents imbalance within a price leg. When price moves aggressively in one direction and leaves inefficiency behind, that inefficiency is internal to the range. It sits inside the dealing range of that move. Price will often come back to rebalance that area before continuing. External range liquidity is different. External range liquidity is a swing high or a swing low. It is the buy-side liquidity resting above highs or the sell-side liquidity resting below lows. These are the obvious liquidity pools that most traders can see. They sit outside of the current range, which is why we call them external. Now, putting those two together, what is the relationship between them? The market really only does two things. It either reaches for old highs or old lows, which is external range liquidity, or it seeks to rebalance inefficiency, which is internal range liquidity in the form of a fair value gap. Understanding this makes price action much simpler. After price takes external range liquidity, meaning it runs a swing high or swing low, it will often seek internal range liquidity next. That means after sweeping an old high or old low, price will retrace into a fair value gap to rebalance. Then, after price reaches that internal range liquidity and rebalances the fair value gap, what does it usually do next? It reaches back for external range liquidity again. It goes for another old high or old low. So price constantly rotates between these two. For example, after reaching external liquidity at a swing high, where can we anticipate price going next? We can anticipate it retracing into an internal fair value gap within the range. Then once price reaches into that fair value gap and rebalances the inefficiency, where can we anticipate it to go next? Back to external range liquidity, meaning another swing high or swing low. So you can see the rhythm of the market. It moves from external range liquidity to internal range liquidity, then back to external range liquidity. High to imbalance, imbalance to high, low to imbalance, imbalance to low. Once you understand this rotation, you stop randomly drawing levels and instead start anticipating where price is likely to draw next. Now let's hop into the charts and go over some real examples of how price moves from external liquidity to internal liquidity and back again. We are on the S&P Futures weekly chart for our first example. You can see right here that price failed to displace below this old low, which is a swing low. That swing low represents external range liquidity. Since price could not aggressively close below it, we have to start thinking about where price may draw next. If we are going to retrace from here, where is the most logical internal range liquidity? We have a fair value gap sitting right here inside the range. That becomes the internal liquidity target. So in this case, we are anticipating a move from external liquidity, which is the swing low, into internal liquidity, which is the fair value gap. Let's see what happens. Price reaches into that internal liquidity. Now the next question is, if we are going to respect this fair value gap, where is price likely to go next? If the fair value gap holds, then price should reach back for external liquidity. The nearest external liquidity in this case would be an old high. If price does not respect the fair value gap, then it is more likely to continue higher toward that old high anyway. And as you can see, price does in fact reach that external liquidity. At this point, we do not yet have internal liquidity because there is no fair value gap formed from this leg up. So we wait. On the next candle, we now have internal liquidity in the form of a fair value gap. That gives us a new internal target if price retraces. If you have seen my daily bias model, you will also notice that we failed to displace below the previous bar and closed back inside. That gives a bullish narrative. So from here, I would like to see price draw back into that internal liquidity and then continue higher. Price reaches into the internal liquidity. Now, if we are going to respect this area and rotate lower, where is price likely to go? Back to external liquidity. That would be a swing low. And that is exactly what happens. Price trades down into external liquidity again. Now, do we have a fair value gap? Not yet. So there is no internal liquidity formed from that move. On the next move, we finally get a fair value gap. If we zoom out, you can also see we just took this low over here, which is external liquidity. So now we can anticipate a potential move from external liquidity back into internal liquidity. Instead, what happens is price displaces aggressively over that fair value gap, creating an inversion. That shifts the narrative bullish. If that inversion is respected, I now want to see price reach for the next external liquidity, which would be an old high. Ideally, I would like to see a retracement into internal liquidity before reaching for that high. But as you can see, it does not always happen perfectly. In this case, price simply continues higher without giving the clean retracement. That is important to understand. These concepts do not guarantee perfection. They provide narrative and bias. Understanding the relationship between internal and external liquidity allows you to frame directional bias. This is a weekly chart. So if you can correctly identify the rotation between external and internal liquidity on the weekly time frame, that can give you directional bias for the entire week. Now let's hop into some top-down examples and look at how to use this higher time frame relationship to refine entries on lower time frames. For our first top-down example, we are going to look at gold on the 60-minute chart. If you notice here, we have a fair value gap that price is currently respecting. That fair value gap represents internal range liquidity. Now, if we are going to continue lower from this area, where is price most likely to draw toward? The obvious target would be this old low, which represents external range liquidity. So on the hourly chart, we have a clear narrative. Price is respecting internal range liquidity, and the logical draw is external range liquidity at the old low. That gives us our higher time frame bias. With that bias in mind, we now drop down to lower time frames to look for short setups that align with this idea. Here we are on the 5-minute chart. You can see prices trading inside a fair value gap on this time frame as well. Since our higher time frame bias is bearish, we are only interested in short setups targeting that old low on the hourly chart. I will wait for the start of my session because I want volatility and liquidity to come into the market. Once the session begins, I am focused strictly on short setups. Price displaces down. At this point, I could enter at this fair value gap. However, if I want additional confirmation, I prefer to see a high form inside the 5-minute fair value gap, have price respect it, and then shift down to a lower time frame for a refined entry. You can see here that price respects the 5-minute fair value gap. That tells me the internal liquidity on this lower time frame is being respected in line with the hourly narrative. Now I drop down to the 1-minute chart. On the 1-minute chart, we put in a high inside that 5-minute fair value gap and then displace lower. Looking at the last up-close candle before displacement, once price takes liquidity, my focus is on that order block as an entry. So I would be looking to enter short at that order block, place my stop above the high that was formed inside the fair value gap, and target the old lows from the hourly chart, which represent external range liquidity. Let's see how it plays out. Price moves lower and delivers approximately 3.23 R. So what did we do here? On the hourly chart, we identified the relationship between internal range liquidity and external range liquidity to create bias. On the 5-minute chart, we refined the structure and allowed an intermediate term high to form. Then on the 1-minute chart, we executed with a precise entry model. This is how you use internal to external liquidity top-down. The higher time frame gives you the narrative. The lower time frames give you the execution. So here we are on GBPJPY. If you notice, we just took an old high. That old high represents external range liquidity. Now that external liquidity has been taken, the next logical question is, where is internal range liquidity? We have a fair value gap sitting right here. That becomes our internal liquidity target. Thinking one step ahead, if price reaches into that internal range liquidity and continues trending higher, where would the next external range liquidity be? It would be this old high up here. So we mark that out as well because that becomes the next draw on liquidity. Now let's drop down to the 4-hour chart and refine this. On the 4-hour, you can clearly see the old high that was taken. I have the new external range liquidity marked above, and we also have internal range liquidity from the weekly in the form of that fair value gap. Interestingly, what forms the weekly fair value gap are actually old lows on the 4-hour. That is important because it shows how time frames align. What is internal on one time frame may look like external structure on a lower one. We displace below that old high and begin retracing into a fair value gap. From here, I would like to see price run those lows, and that is exactly what happens. We get displacement down, then a retracement into a fair value gap, and then another leg lower. Now price has reached internal range liquidity. If we are going to move from internal back to external, where do our eyes go? Up to the external range liquidity above. That shifts our narrative from a sell model into a buy model. The first thing I want to see is a change in the state of delivery, which happens when we close over this high. That confirms the shift. Now my eyes are focused on external range liquidity above. If I were looking for a swing position, I would want to see price retrace into internal liquidity and then get long targeting that old high. However, price does not give a deep retracement. Instead, it respects a new fair value gap and continues higher. So let's refine the entry. We now have a new fair value gap on the 4-hour chart. That is internal range liquidity on the 4-hour. If I am targeting external range liquidity on the 4-hour, I am looking up here. As price enters that internal liquidity, I can anticipate a move toward external liquidity. Now let's drop down to the 15-minute chart. On the 15-minute, you can see price consolidating right at the fair value gap. We get a sweep below the consolidation lows, and then a change in the state of delivery. That gives us confirmation for a buy. I would be looking to enter at this order block, place my stop below the swept low, and target the external range liquidity on the 4-hour. If I want to hold runners, I could target the old high on the weekly chart. Price tags us in, gives an aggressive move higher, and hits the 4-hour external liquidity target. Then it continues higher and reaches the weekly external range liquidity. Zooming back out to the 4-hour chart, you can see how this smaller market maker buy model fits inside a larger time frame. Market maker buy model. To summarize, on the weekly we moved from external range liquidity to internal range liquidity and then back to external range liquidity. On the 4-hour, we transitioned from a sell model to a buy model using the same internal to external framework. Then on the 15-minute, we executed using the same logic. This is the power of understanding the relationship between internal and external liquidity across multiple time frames. It allows you to build a narrative from the higher time frame and execute precisely on the lower time frame. All right, so that wraps up internal and external range liquidity. The main thing you need to remember is that the market rotates between the two. It moves from external liquidity to internal liquidity, and from internal liquidity back to external liquidity. High to imbalance, imbalance to high, low to imbalance, imbalance to low. Once you understand that rhythm, bias becomes much clearer. You stop randomly guessing direction and start asking a simple question. Where did price just come from? And where is the next logical draw? When you apply this top-down, using the weekly or 4-hour for narrative and the lower time frames for execution, it becomes a very structured way to trade. Do not just memorize definitions. Go into your own charts and practice marking internal and external liquidity across multiple time frames. That is where the real understanding comes from. If this helped you, make sure you like the video, subscribe to the channel, and share it with someone serious about improving. I will see you in the next one.